Welcome to How to Make Money Music Royalty Investing. Part 1. The Bedrock of Value, Understanding Music Rights. Chapter 1. The Two Halves of a Song, Master versus Publishing Rights. To understand how to invest in music, you first have to understand what, precisely, you're buying and selling. At the heart of every song, every melody, every lyric that has ever been recorded, there are two distinct and separate forms of property. This concept is the most critical thing you'll learn, because every single dollar of revenue flows from one, or both, of these foundational rights. First up is the composition right, which you'll also hear called the publishing right. Think of this as the song's architectural blueprint. It's the core essence of the song itself, the melody, the harmony, the lyrics, and its structure. This right belongs to the creators, the songwriters and composers who brought the song to life. Legally, they own it the moment they write it down or record it in any way, whether that's lyrics scribbled on a napkin or a tune hummed into a phone. The people who hold these rights, the songwriters and their partners, the music publishers, get to control how this blueprint is used. The second half of the equation is the master right, also known as the sound recording right. If the composition is the blueprint, the master is the actual house built from that plan. It's the specific, captured performance of the song that you actually hear. This right is owned by whoever paid for the recording session. Historically, that's almost always been the record label, which fronts the money for studio time, producers, and marketing. But today, with so many independent artists, it's more and more common for artists to pay for their own recordings and keep ownership of their masters. Here's a great example: Dolly Parton's classic song, "I Will Always Love You." Dolly wrote it, so she owns the composition rights. Her 1974 recording is one master. But Whitney Houston's iconic 1992 version is a completely separate master, owned by her record label. Every cover song, every live version, every remix creates a brand new master recording, but they all point back to that one, single, underlying composition written by Dolly. This division isn't just a technical detail. It's the engine of the music business and the core of how you'll analyze any investment. This separation has historically given record labels immense power, since they own the main products sold to the public. For you as an investor, this same separation creates a huge opportunity. You can choose to buy only the publishing rights to a song, which often gives you a more stable and diverse income stream. A publishing asset earns money whenever that song is performed by anyone, anywhere, on the radio, in a commercial, or as a cover by a new artist. Alternatively, you can invest in the master rights, which ties your investment directly to a specific recording by a specific artist. The money from a master is only generated when that particular version of the song is played or sold. This allows you to decide your risk profile. Are you betting on the timeless quality of the song itself, or on the popularity of a specific artist's recording? This duality also creates a hidden value in the market, especially in the world of TV shows and movies. Music supervisors for films and ads are always under pressure. To use a song, they need permission from both the publishing owner and the master owner. That two-step process can be slow. Because of this, songs where both the master and publishing rights are controlled by one single person or company are known as one-stop, clearable. These songs are worth more because they're easy and fast to license, making them much more attractive. A smart investor, therefore, will look not just at a song's past earnings, but also at how easy it is to license, a hidden driver of its future value. Chapter 2. The 4 Key Royalty Streams. Once you understand the two core rights, the next step is to see how they actually make money. Income flows to the owners of these rights through 4 main streams. Each one is triggered by a different kind of music use, and understanding them is essential to figuring out any royalty statement. First are mechanical royalties. This is the manufacturing royalty. It's paid to the owner of the composition whenever a copy of the song is made. The name is a throwback to the era of player piano rolls. Today, it applies to physical sales like CDs and vinyl, digital downloads from iTunes, and most importantly for modern investors, interactive streams on platforms like Spotify and Apple Music, where you actively choose to play a song. In the United States, these rates are actually set by a government body called the Copyright Royalty Board, which makes them predictable. Second are performance royalties. This is the public play royalty. It's generated whenever a composition is performed or broadcast to the public. This covers a huge area: AM, FM radio, TV broadcasts, live concerts, music played in bars and restaurants, and all kinds of streaming, from Spotify to Pandora Radio. Think of it as a fee paid for the right to broadcast the song's blueprint to an audience. Third are synchronization royalties, which everyone just calls sync royalties. This is the visual media royalty. It's usually a one-time fee paid to license music for use in a movie, TV show, commercial, or video game. To do this, you need permission from both the composition owner and the master recording owner. Sync fees are privately negotiated and can range from a few $100s to hundreds of thousands of dollars for a major ad campaign. Finally, there are print royalties. This is the sheet music royalty. It's a smaller income stream from the sale of printed musical scores, guitar tabs, and lyrics. While it's less of a factor in the digital age, it can still be relevant for certain kinds of music, like classical, jazz, or educational songs. To make this crystal clear, let's just talk through a quick summary. Mechanical royalties are for the publishing right, from sources like CD sales and Spotify streams. They're collected by groups like the MLC or the Harry Fox Agency. Performance royalties are also for the publishing right, from sources like radio, TV, and concerts. They're collected by ASCAP, BMI, and SCSAC. Synchronization royalties are for both the master and publishing rights, from sources like movies and commercials. These are usually negotiated directly. Print royalties are for the publishing right, from sheet music sales, and are handled by music publishers. This framework is your key to understanding who pays whom for what in the complex world of music. Chapter 3. The Money Pipeline. How a single stream pays everyone. The journey of a dollar from a listener's Spotify subscription to an investor's bank account is a winding one. Understanding this money pipeline is crucial because its complexities are exactly what create the investment market in the first place. The key players in this pipeline are collection societies. In the United States, there are three main types. First are the performing rights organizations, or PROs. You've probably heard of them: ASCAP, BMI, and SESAC. They collect performance royalties for songwriters and publishers. They issue blanket licenses to thousands of businesses, from TV networks to local bars, allowing them to play any song from that PRO's catalog. The PROs then track what was played and send the money to the correct rights holders. Next is the Mechanical Licensing Collective, or the MLC. Created by the Music Modernization Act of 2018, the MLC is a nonprofit that handles mechanical royalties from streaming services like Spotify. They collect the money and distribute it to publishers and songwriters, bringing much-needed transparency to the process. Finally, there is Sound Exchange. This organization has a very specific and critical job. It collects and distributes digital performance royalties for the master recording. This is the royalty paid to artists and labels when their song is streamed on a non-interactive service, like Pandora or SiriusXM satellite radio. In the US, traditional radio only has to pay the songwriter, not the performing artist, but digital radio has to pay both. Sound Exchange has a strict formula. 45% of the money goes to the main artist, 5% to the backup musicians, and 50% goes to the owner of the master recording, which is usually the record label. With that in mind, let's trace the money from a single stream on Spotify. When you choose to play a song, Spotify pays out about 70% of its revenue to rights holders. That payment is split into two big buckets. The master royalty goes to the record label, which then pays the artist based on their contract. The composition royalty is more complex. It's split again into a mechanical royalty, which goes to the MLC to pay the publisher and songwriter, and a performance royalty, which goes to the PRO, like ASCAP, to pay the publisher and songwriter. This complicated process reveals a huge risk and a potential opportunity known as black box royalties. These are funds that have been collected but can't be distributed because the rightful owner can't be identified, usually due to bad song data. For years, this money would pile up and then be paid out to the biggest publishers based on their market share, not who actually earned it. This means an investor buying a poorly managed catalog might be able to clean up the data, properly register the songs, and claim a chunk of these historical, uncollected funds, unlocking hidden value. We've covered a lot of ground in Part 1. How are you feeling about it so far? If this deep dive into how the music industry really works is fascinating to you, take a quick moment to subscribe. That way, you won't miss the next parts, where we get into the practical steps of how you can start investing. Part 2. The Investor's Toolkit, Analyzing and Valuing Royalties. Chapter 4. Entering the marketplace. Platforms like Royalty Exchange. Now that you have a solid understanding of music rights, you're ready to enter the market. The main places for everyday investors are specialized online platforms that have opened up this once exclusive asset class. The most well-known is Royalty Exchange, which acts as a neutral marketplace connecting creators who need funding with investors who want to buy royalty assets. Royalty Exchange offers two main ways to buy. First is the auction house. Here, a seller lists an asset, and a competitive auction begins, usually lasting a few days, with the asset going to the highest bidder. The second, more active venue is the exchange. This works more like a stock market, with hundreds of assets listed at a list price. You can either accept that price for an immediate sale or submit a counteroffer to negotiate. While Royalty Exchange is a major player, other platforms serve different needs. Songvest, for example, offers a cool hybrid model. It has auctions for whole assets, but it has also pioneered fractional shares called song shares, which are qualified by the SEC. This lets you buy a tiny piece of a song's royalty stream for as little as $100, which is a great entry point for beginners. If you're looking for geographic diversification, Enote Music is a leading European platform. It also uses a fractional share model, allowing you to buy and sell shares in various catalogs with a focus on European artists. Choosing the right platform depends on your strategy and how much you want to invest. Let's compare them. Royalty Exchange is best for investors with larger amounts of capital, say $10,000 or more, who want to own entire royalty assets. Its key features are its active secondary market and detailed analytics. Songvest is perfect for beginners and those wanting to test the waters with small amounts. You can start with as little as $100 to buy its SEC-qualified fractional shares. Enote Music is great for European investors or anyone seeking to diversify their portfolio geographically. It offers fractional shares, often starting around just $10, and has an active secondary market for trading. Chapter 5. Case Study. Deconstructing the phrase, how to save a life. Financial metrics can feel a bit abstract, so let's make them real. Imagine we're looking at a listing for the songwriter's share of public performance royalties for a catalog that includes the huge 2005 hit, How to Save a Life, by The Fray. This song is a perfect example of an evergreen asset, a timeless classic that keeps generating a ton of money nearly 2 decades after it was released. The first thing you'll see on the listing is the LTM, which stands for last 12 months' earnings. This tells you the total income the asset generated in the most recent year. Let's say for our Fray catalog, the LTM is $20,000. This number is your baseline for everything. But LTM alone isn't enough. This is where the next key metric, dollar age, comes in. Dollar age is a metric developed by Royalty Exchange to measure the quality and stability of a catalog's earnings. It gives more weight to earnings from older songs, which are considered more stable. The formula is a bit complex, but the idea is simple. For each song, you multiply its annual earnings by its age in years. You add all those numbers up, and then divide by the catalog's total annual earnings. A high dollar age, maybe 8 years or more, tells you the earnings are mature and low risk. A low dollar age, like 2 or 3 years, means the income is from a recent hit and is very likely to drop off fast. For our How to Save a Life catalog, the dollar age would be very high, well over 10 years. This immediately tells an investor that the $20,000 LTM is not a temporary spike, but a reflection of sustained, predictable performance. The listing will also show you the trend rate and source of earnings. Is that $20,000 part of an upward trend, or a gentle decline? And where is the money coming from? For How to Save a Life, you'd see a healthy mix. There would be consistent radio play, a large and growing base of streaming royalties, and, critically, a history of high-value sync placements. The song's use in iconic TV shows like Grey's Anatomy not only generated big fees in the past, but it cemented the song's status as a go-to track for music supervisors today. Chapter 6. The Art and Science of Valuation. With the key metrics in hand, the next step is valuation, figuring out what the asset is actually worth. The most common method is the purchase multiple approach. It's a simple calculation where the asset's price is viewed as a multiple of its last 12 months' earnings. If our Fray catalog, with its $20,000 LTM, is listed for sale at $200,000, it's trading at a 10x multiple. The big question for any investor is, what's an appropriate multiple to pay? The answer lies in the asset's quality, risk, and growth potential. A low multiple doesn't automatically mean cheap, and a high multiple doesn't mean expensive. It's a reflection of expected future performance. The most important factor is the stability of the earnings, which is best captured by the dollar age. Evergreen catalogs with a high dollar age demand higher multiples, typically in the 10x to 15x range, because their income is considered low risk. Newer catalogs, which are expected to decay rapidly, trade at much lower multiples, often between 5x and 10x. Our Frey catalog would justify a multiple on the higher end of that range. Other factors include the diversity of income. A catalog that earns from multiple streams is less risky and deserves a higher multiple. A more sophisticated valuation method is the discounted cash flow or DCF analysis. This method tries to calculate the true value of an asset by projecting all of its future cash flows and then discounting them back to a single present-day value. It forces you to think critically about the song's future. Will streaming continue to grow? Is another big sync placement likely? An investor's main job is to find assets where their own analysis of risk is different from the market's. If you believe a catalog's earnings are more stable than its multiple suggests, you've found a potential value opportunity. Chapter 7. Earning Patterns. One-hit wonders versus evergreen classics. Not all royalty streams are created equal. Different types of songs have very distinct earning patterns, and understanding these archetypes is key to building a successful portfolio. The most common pattern, especially for new music, is the L curve. When a new song becomes a hit, its earnings spike dramatically for the first year or so. But this peak is almost always followed by a sharp decay as the song fades from public attention. Eventually, the earnings stabilize at a much lower level, forming the long tail of the L shape. Overpaying at the peak of the L curve is one of the most common mistakes a new investor can make. In stark contrast are evergreen catalogs. These are the gold standard for investors who want stable, predictable, long-term income. They contain songs that have proven their staying power over decades. They are the cultural bedrock, songs played at weddings, featured in films, and passed down through generations. Their earnings are characterized by remarkable consistency. Within the evergreen category is a uniquely profitable niche, Christmas music. These catalogs are the ultimate annuity. They generate massive, reliable spikes in royalty income every single fourth quarter. A key reason is that their limited seasonal exposure prevents people from getting tired of them. The financial impact is staggering. Mariah Carey's All I Want for Christmas Is You is estimated to earn her about $2.5 million in royalties each year. Finally, there's the one-hit wonder. From an investment perspective, a single massive hit can be an incredibly valuable asset. The key is the song's afterlife. If it becomes a favorite on throwback radio or a go-to sync placement for movies trying to capture a specific time period, its long tail can be very lucrative. Part 3. Advanced Strategies and the Broader Market. Chapter 8. Beyond Direct Ownership, ETFs, Funds, and Private Syndicates. While buying royalty assets directly offers the most control, it's not the only way to get involved. The last decade has seen a massive flood of institutional money into the music space, creating new ways for you to invest. This gold rush has been led by specialized music investment funds. Firms like Hypnosis, Primary Wave, and Round Hill, along with financial giants like Blackstone, have spent billions of dollars to acquire the catalogs of iconic artists, from Neil Young and Shakira to Justin Timberlake. These funds operate on a simple idea: buy high-quality assets that produce predictable cash flow, and then manage them to make them even more valuable. When these funds are publicly traded, they offer investors a way to buy into a diversified portfolio of music rights through a single stock, with returns paid as dividends. For those who prefer the traditional stock market, there are music ETFs. The most notable is the MUSQ Global Music Industry ETF. It's important to understand, though, that an ETF like MUSQ is not a direct investment in royalties. Instead, it holds stocks of companies in the music business, like Universal Music Group, Spotify, and Apple. Investing in MUSQ is a bet on the overall growth of the entire music industry, not a specific song. A third path is the private syndicate. Sometimes, platforms will offer accredited investors the chance to buy a share in a single, high-value catalog, like the score music from the movie Shrek. And newer platforms like linktopublic.com have started offering fractional shares of specific royalty assets to all U.S. investors, allowing you to own a piece of an asset without needing to buy the whole thing. The flood of institutional money is a powerful sign that royalties are a serious asset class. But it creates a challenge for retail investors, as the big funds have driven up the prices for iconic, blue-chip catalogs. The opportunity for you often lies not in competing with Blackstone, but in exploring the middle market, high-quality catalogs from less famous but still successful artists that are too small for a massive fund to bother with. This is where a diligent individual investor can find their edge. Chapter 9. The Future is Now, AI, NFTs, and the New Frontier. The music royalty landscape is not standing still. It's being reshaped by powerful new technologies that present both threats and opportunities. Two of the most significant are artificial intelligence and non-fungible tokens. Artificial intelligence, or AI, is a double-edged sword. On one hand, it's a potential threat. AI can now generate tons of high-quality, royalty-free music, creating a cheap alternative for content creators and potentially reducing the demand for licensed tracks from human artists. On the other hand, AI is also becoming an essential tool for the smart investor. It can analyze huge datasets to forecast future royalty streams, identify rising genres, and even pinpoint under-monetized songs in a catalog that could be pitched for new sync licenses. The other major frontier is non-fungible tokens, or NFTs. In theory, NFTs offer a revolutionary way to handle music ownership. Using blockchain-based smart contracts, an artist could sell fractional ownership of their future royalties directly to their fans, and those smart contracts could automatically distribute payments in real time. This model promises to cut out the middlemen and create a more direct link between artist, fan, and investor. However, the practical reality of music NFTs has yet to catch up to this promise. The legal and technical challenges are still immense. For now, most music NFTs are more like digital collectibles than true royalty investments, but the technology holds huge potential for the future. Chapter 10. Investing in the Zeitgeist, Sync Placements and Viral Hits. While long-term stability is great, the market also offers moments of explosive, unpredictable growth. Two of the most powerful drivers of this are sync placements and social media virality. A single song placed in a popular TV show can have a dramatic impact on its value, an event often called the Stranger Things effect. When Kate Bush's 1985 song, Running Up That Hill, was featured in the show Stranger Things, it triggered a cultural phenomenon. Streams increased by an almost unbelievable 9,900%. This single-handedly showed the immense hidden value that can lie dormant in an older catalog. Today, the modern equivalent of a major sync placement is a song going viral on a platform like TikTok. When a song becomes the soundtrack to a viral dance or meme, millions of user-generated videos act as a massive promotional campaign, driving people to Spotify to listen to the full track. For an investor, it's nearly impossible to predict which song will be the next to blow up. The strategy, therefore, is not to chase virality, but to invest in catalogs that have the traits that make them more likely to be chosen for these opportunities. Music supervisors and content creators often look for songs that are upbeat, emotional, and easy to license. Investing in virality is less about predicting a specific trend and more about owning a portfolio of high-quality, sync-friendly lottery tickets. Part 4. Protecting your investment. Chapter 11. A Guide to Risk, Copyright, Controversy, and Competition. No investment is risk-free, and while music royalties are unique, they are not immune. The biggest appeal of music royalties is their low correlation to the stock market. A recession doesn't usually cause people to stop listening to music, but they carry their own distinct risks. The most significant is legal and copyright risk. An investment is only as secure as the legal title of the copyright. A messy ownership history can lead to legal battles that freeze royalty payments for years. There is also artist controversy risk. A music catalog is tied to the public image of its creator. If an artist gets embroiled in a major scandal, the financial fallout can be swift and severe. Radio stations drop their songs, playlists remove them, and brands won't license them. This cancellation can directly hurt the royalty income you receive. Beyond these risks, there is the inherent performance risk of the asset itself. The earnings of most songs naturally decay over time. The biggest financial danger is overpaying for a song at its peak, only to see its earnings collapse. And finally, there's technological and industry risk. The music business is always evolving, and changes in technology, consumer behavior, or regulations can all impact a catalog's future value. If you're finding this guide to the risks and rewards valuable, I hope you'll consider subscribing. It's the best way to support this work and make sure you get all the insights as they're released. Chapter 12. Investor Beware, Scams, Fraud, and Red Flags. While the leading marketplaces are legitimate, the growing popularity of this asset class has attracted bad actors. You must learn to spot the warning signs of a fraudulent listing. A stark cautionary tale emerged in 2024 with the indictment of a musician charged with a massive streaming fraud scheme. Prosecutors alleged he used AI to create hundreds of thousands of generic songs and then used an army of bots to stream them billions of times on Spotify. He fraudulently collected over $10 million in royalties that should have gone to legitimate artists. This case is a crucial lesson. Raw streaming numbers can be manipulated. To protect yourself, approach every deal with a healthy dose of skepticism and a rigorous checklist. Let's walk through some of the most common red flags. First, a lack of transparency. This is when the seller is unwilling or unable to provide complete, detailed, historical royalty statements directly from the collection societies. This is a problem because the earnings figures in the listing might be inflated or fraudulent. Without verifiable source data, you can't confirm the asset's true performance. Second, pressure to act quickly. This is a classic tactic. The seller creates a false sense of urgency, claiming other buyers are circling. A legitimate, high-quality asset and a reputable seller can always withstand scrutiny. Third, unverifiable claims. The listing makes grand claims, like being a huge international hit, without providing official chart data or royalty statements from those countries to back it up. The asset's value is likely being exaggerated. Fourth, vague or messy legal title. The ownership documents are unclear or incomplete, and the seller discourages you from having a lawyer review them. You could be buying a future lawsuit. Fifth, inconsistent data. The summary numbers in the listing don't match the detailed royalty statements. This indicates either extreme sloppiness or intentional deception. And finally, unrealistic projections. The listing projects future earnings that show dramatic growth with no clear justification. Projections should be conservative and data-driven. Unrealistic forecasts are a common way to trick inexperienced investors into overpaying. Chapter 13. The Taxman Cometh, Managing Your Royalty Income. A crucial, and often forgotten, part of calculating your true return is understanding taxes. For an individual investor, royalty income is generally classified by the IRS as passive income and is taxed at your ordinary income tax rates, not the lower capital gains rates. This income is typically reported on Schedule E of your tax return. While that might not sound great, there is a powerful tax benefit available to royalty investors: amortization. A music catalog is considered an intangible asset. Under Section 197 of the U.S. Tax Code, the purchase price of many of these assets can be amortized, or deducted in equal parts, over a 15-year period. For example, if you buy a catalog for $150,000, you can take a tax deduction of $10,000 per year for 15 years. This annual deduction can be used to offset the royalty income you receive, significantly reducing your tax bill and boosting your after-tax return. Given these rules, strategic planning is essential. Many serious investors hold their royalty assets within an LLC, which can provide liability protection and other benefits. And if your catalog earns money globally, you'll need to navigate international tax treaties. This almost always requires the guidance of a qualified tax professional. Conclusion: composing your financial future. We have journeyed from the fundamental nature of a copyright to the complex algorithms of valuation, from rock legends to artificial intelligence. We have seen how a simple stream of a song transforms into a durable, investable asset. The core principles of successful music royalty investing are clear. First, understand the asset. Second, do your due diligence. Third, analyze the data with discipline. And finally, be aware of the risks. Music royalty investing offers a truly unique proposition: the opportunity to own a piece of our shared culture, to invest in an asset that brings joy to millions, and to generate a stream of passive income that is largely uncorrelated to the whims of the traditional stock market. It is an asset class powered by one of the most fundamental and enduring of human desires, the need to listen to music. By applying the principles from this guide, you are now equipped not just to be a passive listener, but an active and informed investor. The soundtrack of our lives is playing. Now, you know how to own a piece of it.